This segment of Safeguard Your Savings goes into different types of investment fraud. Let's begin now. Fraud involves deceiving a person by misrepresenting the truth in order to deprive them of something, such as their hard-earned savings. State and federal officials estimate that financial swindles cost American consumers around $40 billion a year. Victims can range from the rich to lower-income blue-collar workers. The best protection against investment fraud is to learn how to spot and avoid the various types of scams. Con artists appeal to the greed of some victims, and in other cases, their fears, such as the inability to accumulate enough money to meet catastrophic medical bills, send children to college, or fund their retirement. Investment con artists or swindlers know what it takes to get a consumer's money. Some swindlers focus on specific groups, such as church groups, African Americans, doctors, or the elderly, and offer pitches tailor-made to their needs or concerns. Others take advantage of economic downturns and employment uncertainty. Swindlers now can use internet access and other technological channels to solicit fraud. It is therefore important to be familiar with the common types of investment fraud and the key warning signs for each type. Let's now take a look at the top 10 threats to Missouri investors as identified by the Missouri Securities Division. Free lunch or dinner offers. These meetings often target nearly or newly retired investors by inviting them to investment, retirement, or tax planning seminars. Along with the free meal often comes the promise of investments with high returns and little or no risk. Senior specialists. Individuals may call themselves senior specialists or use professional sounding designations to create a false level of comfort among seniors and then get them to invest. Real estate investment schemes. Investments in real estate are often viewed as a sure thing with little downside risk. But putting your money into real estate investment contracts can involve significant risk, and like other investments, they are often subject to full regulation under state and federal securities laws. Be aware that investment scams featuring real estate are on the rise. Variable and equity indexed annuities. Complicated investments that combine features of mutual funds, annuities, and insurance are often unsuitable for older investors. These usually include higher than normal fees and can limit your ability to access your money for many years unless you're willing to pay surrender fees. Oil and gas scams. Rising oil and natural gas prices have made a variety of traditional and alternative energy projects attractive to investors. Many of these investments are highly risky and not appropriate for smaller investors. Affinity fraud describes investment schemes that prey upon members of identifiable groups. Con artists promote affinity scams that exploit the sense of trust and friendship that exist in groups of people who have something in common. Con artists recognize that the tight-knit structure of many groups makes it less likely that a scam will be detected by regulators and law enforcement officials, and that those who become victims will be more likely to forgive one of their own. Affinity fraud swindlers will enlist respected leaders within a community or group to spread the word about an investment deal. Unsuitable recommendations. Securities professionals are obligated to know both their customers' financial situations and to avoid unsuitable investment recommendations. But advisors can earn higher commissions on certain products, so they don't always adhere to the suitability standards. Unlicensed sellers and unregistered products. The sale of securities by someone without a valid securities license should be a red flag for investors. Con artists try to bypass stringent state registration requirements to pitch unusual investment ideas. Prime bank schemes. These often promise high tax-free returns. Promoters of these schemes offer to let the little guy in on what they claim are exclusive investments from elite overseas banks. Don't be fooled, though. Prime banks of this type do not exist, and scam artists have no intention of creating a profit for anyone but themselves. Investing in death benefit contracts. Buying the death benefit of a life insurance policy has become a growing issue. Brokers sometimes sell the life insurance policy of a terminally ill patient for a price below what is promised to be paid upon death. They claim the investor can collect the full value of the policy's death benefit when the policyholder dies. Pyramid schemes operate on the principle that each member of a group will receive a profit or a cut for recruiting new members to join the scheme. Pyramid investment scams are different from legitimate sales organizations that recruit individuals to expand their sales staff. Illegal pyramid schemes offer participants payment for recruiting new members into the sales force rather than for selling products. The problem with pyramid schemes can be explained simply. There are not enough potential participants in the whole world to keep pyramids growing steadily for even a few months. Warning signs of pyramid scams include sky high profits are promised for a small amount of effort, sellers and buyers are expected to recruit new sellers and buyers to keep the pyramid growing, people must pay a membership fee to participate in the scheme. If products are offered, they will cost more than similar products. Unrealistic claims are made about product quality or performance, and participants are paid for recruiting others. Ponzi schemes are a type of pyramid scheme named for Charles Ponzi, who duped thousands of New England residents into investing in a postage stamp speculation scheme. Ponzi determined that it was possible to take advantage of differences between U.S. and foreign currencies to buy and sell international mail coupons. Ponzi collected funds from investors, taking in $1 million during a single 3-hour period. Although he paid a few early investors in order to make the scheme look legitimate, an investigation found that Ponzi had purchased only about $30 worth of the international mail coupons. Ponzi worked in the 1920s. However, even today, Ponzi schemers continue to use his tactics. Money from new investors is used to pay off earlier investors. Stock swindles pose a major threat to consumers. In the late 1980s, small investors lost $2 billion in scams involving penny stocks, so named because the shares sold for less than $3. In the late 1990s, investors were victimized in the systematic manipulation of micro-cap stocks, which are little-known company stocks with relatively small numbers of shares that can easily be manipulated. A stock swindler may claim that a company has developed a cure for AIDS or is about to announce a business deal that will cause its stock to double or triple in value. In a penny stock example, con artists convinced investors to put millions of dollars into a non existent company supposedly developing a self chilling beverage can that would eliminate the need to refrigerate soda and other liquids. The deal failed and investors saw their money go down the drain. Phony international investments is a fast growing area of interest for U.S. investors. With the rapid pace of political and economic changes overseas and the strong performance of some foreign stock markets, many American consumers are investing funds abroad. Con artists have responded by offering scams with an international flair. Even when U.S. investors deal with legitimate investment opportunities overseas, they remain vulnerable to such factors as loose or non existent investor protection regulation, currency fluctuations, limited opportunities to pursue grievances, and political instability in some nations. This segment takes a deeper look into the world of investment fraud and how to protect yourself from it. Email and websites are the newest friends of scam artists. However, the telephone remains the swindler's weapon of choice. Fraudulent sales callers have one thing in common: they are skilled liars and experts at deceit. There is no certain way to determine whether a sales call is honest simply by talking with someone on the phone. That's why sales calls from unknown persons should always be thoroughly researched before investing. Phone swindlers are extremely good at sounding as though they represent legitimate businesses. They offer investments, describe employment opportunities. The list goes on and on. You can never assume that you will immediately recognize a phone scam. The following are some of the hallmarks of a phone based investment scam: sales pitches with slick talk about little or no risk, secret tips, and unrealistically high rates of return. The rate is usually much greater than that for more traditional investment opportunities. Demand for immediate action. The last thing a phone swindler wants is for a potential victim to have time to reflect upon the phony investment or, even worse, seek the advice of a trusted, knowledgeable third party such as an accountant, broker, securities regulator, or bank. Swindlers often push victims to send money immediately or offer to pick it up by courier or delivery service. No disclosure of their street address. Instead, con artists will frequently use a mail drop. This decreases the chances of them being caught by local law enforcement officials. No use of U.S. mail. Many con artists fear that federal mail fraud statutes will be invoked against them as a result of their schemes, so they commonly resort to alternate delivery methods, including overnight delivery services and couriers to pick up the money. Stalling suspicious investors who suspect that they have been defrauded. This process may involve lull letters in which the promoter of the scam blames the temporary delay in the promised high returns on various factors, including weather, union problems, delayed equipment delivery, labor problems, and so on. Such excuses may provide the con artist with valuable additional weeks or months in which to swindle hundreds of additional victims. Pulling a vanishing act. When the heat is on, telephone con artists move on to the next city or state. Very often, this will also involve a switch in scams, so someone who is a precious metal salesperson today may be selling $99 round trips to Hawaii next week. No matter how much regulation there is, the investor is still responsible for their actions. What can you do to make sure that you're not the next victim? Investment con artists do not break into homes. Instead, they get people to give them their money voluntarily. These 4 steps will help protect your hard earned money. Stop and think before acting. Never invest merely on the basis of a sales pitch. Get written information and evaluate it. The first priority of people who sell investments is to make money for themselves and their employers. It is not to ensure the investor's financial future. This does not mean that all people who promote investments are dishonest. It just means that their goals may not be the same as yours. Study the deal and get input. Read the material about the investment to determine how it is supposed to make money. Seek the counsel of someone such as a trusted broker, accountant, banker, or an experienced investor who is more knowledgeable. Never provide personal or financial information like bank accounts or credit card numbers to investment telemarketers, even if they pressure you for it. If the caller is legitimate, the deal will still be available after thoroughly checking it out. Stick to what is clearly understood. You need to stick with investments that you understand, particularly when it comes to the potential risks or rewards. You shouldn't get caught in the trap of trusting a salesperson who claims to understand it all and promises to take care of you. It's important to not sign papers before reading and understanding them. A lawyer or another investment professional should answer any questions concerning the agreement before signing. Apply critical thinking skills. You should ask yourself, does what I am being promised really make sense? Although there are government and industry regulatory offices that actively oversee the investment marketplace, the best forms of protection are good critical thinking skills and sound decision making models to determine the legitimacy of an investment opportunity. State and federal agencies and self regulatory organizations devote millions of dollars and many hours each year to stopping investment fraud. Consumers who are approached by a con artist or have been victimized by such a person should report it to the proper authorities. The longer a con artist goes unreported, the more money victims will lose. Legal protections are limited, and once money is invested in a fraudulent scheme, the chances of getting it back are extremely small. You shouldn't be afraid to invest, but you should be on your guard against getting swindled. This presentation was made possible by the Secretary of State's office as well as the Investor Protection Trust.